Okay, everyone, let's go ahead and get started here. So welcome. My name is Knox Ridley. I'm the portfolio manager and lead technical analyst at the IO Fund. I have a special guest with me today, Vincent Duchaine. He's the founder and CEO of Wealth Umbrella. And we're both going to offer some presentations here. And this is the first time we've ever opened up our tactical part of our strategy to the public. And it's not by accident that we're doing that right now. We get a lot of requests from members, new members, people who aren't members, who are asking us questions of, is now a good time to start investing in tech and start investing in crypto? We're not financial advisors, but these are the kind of questions that we get quite frequently. We hear questions like, how to basically, to be summed up, how do I make more money in tech and more money in Bitcoin? And so we think right now is the appropriate time to start discussing capital preservation and risk management tactics, things that are not discussed very frequently within markets. And it's arguably the most important topic when it comes to investing. While we do believe, we believe at the IO Fund that there is more gains to be made, we do believe that we're closer to the end of something notable than the beginning. And so I think risk management is a very important topic here. So the IO Fund portion of this presentation let's see here. This is the itinerary. We're going to talk about who we are at the IO Fund if you don't know who we are or not familiar with us, what our investment process is, specifically around Bitcoin. And then we're going to get into the interactive portion of this presentation, which is we're going to get into some charting. And we're going to talk about Bitcoin, and we're going to talk about the S&P 500 to identify risks and to just let you know quite bluntly what our risk management plan is for the remainder of this bull market that we're in. Okay. So these are the lead analysts at the IO Fund. Beth Kendig, arguably the most renowned tech analyst in the world. She's frequents Tier 1 media, and she handles the fundamental analysis within our strategy. That's me at the bottom, Knox Ridley. I handle all the technical analysis and risk management. And so what is the IO Fund? We started a service in 2019 that basically at its core, we just offer institutional level research into the technology sector that overlaps into some of the crypto space. Like I said before, we frequent Tier 1 media. We're on Fox Business almost weekly, Bloomberg very regularly, CNBC, Real Vision. And we're probably most notably known for our early calls into Nvidia and AI's coming dominance. We were beating the table in 2022. I mean, Beth was on Fox Business, I believe, the Charles Payne show, when Nvidia was in free fall, and the narrative around that was that Ethereum was switching their staking protocol and no one needed the GPUs anymore. So that's going to remove demand. It's not good for Nvidia. And we're sitting here saying, no, the real story is AI. This was in 2022. We backed this up with 9 buy alerts to our premium members to buy Nvidia below $20. That's accounting for the split in 2021 and 2022, and entered 2023 before ChatGPT with 45% of our portfolio in AI hardware. And it's not just with AI. We were early to cloud, early out of cloud. We're early to crypto. Along with, our calls into AI. We also offer a live portfolio. It's managed in real time of all of our positions. We don't only offer research, but we show you how we use that research. We do weekly webinars like this, where we do all interactive charting, discussing buy plans, sell plans, targets, and broad market risk as well. And then we offer real-time trade alerts that we'll send whenever we make an action. We send it to your phone. You get a text message. So pretty robust offering. And we started auditing our portfolio in May of 2020. We have a third-party accounting firm out of San Francisco audit our returns. And you're looking at it right here on the right. Our cumulative returns since we started doing this in 2020 is 210%. To put that in perspective, that would make us the second best performing hedge fund during this time frame, and the 5th best ETF of all ETFs that you can invest in the U.S., the number 5. So pretty good stats. Our process, which really separates us within the tech market, is we focus more on trends, like micro trends, than individual stocks. This is stuff that you don't learn in finance classes. It's not very common within the financial field. The stuff you learn kind of being involved in the VC world within Silicon Valley, which we come from. And by a micro trend, a tech micro trend, I just basically mean the life cycle of an innovative technology. Take the iPhone, for example. In 2009, no one had an iPhone or an Android, it wasn't invented yet. And fast forward to 2018, everyone has one. And so that is the life cycle of a very powerful tech trend. And the companies that it gave us were companies like Apple, Meta, Google. Broadcom was a huge beneficiary within that micro trend. So we focus with the trend first. We use fundamental analysis to identify what stocks to buy within that trend, and technical analysis to tell us how and when to buy those positions. We do not believe in diversification. This is one of the reasons why so many focused ETFs within the tech space fail. If you look at all the AI-focused ETFs that have been offered over the last 2 or 3 years, they've all gotten slaughtered by the NASDAQ 100. And if you look at their holdings, they're like 50 plus positions. This is just not how micro trends work. Especially within AI, we're in a very specific stage within the AI micro trend. The early innings, the infrastructure build out phase, we're just starting to enter the software phase of that. But still within the AI hardware phase, there's only 4 companies that are really benefiting. They're having direct revenue from that build out. And then there's indirect companies that are suppliers to these bigger companies. So what's the point of investing in future software plays that have zero revenue and just pie in the sky ideas that might manifest one day? We don't really believe in that. And that's why fundamental analysis is so important for this process. We currently manage a portfolio of 15 positions. 63% is in our top 5. 2 of those positions are cryptocurrencies, just to give you an idea of how we manage money. So moving forward, our process with Bitcoin is very unique. There are no earnings reports. There's no 10K reports. There's no revenue analysis. There's no management team. There's no competition. Some might want to argue with me that maybe Litecoin has a shot. I think that's a dumb argument. Bitcoin is the de facto winner of the digital store of value. So what moves price? If it's none of the standard metrics that move equity prices. Most people assume it's narratives, things like the strategic Bitcoin reserve or ETFs being opened up to institutions, opening up, the possibility for institutional adoption, which those are very bullish narratives. But if you use narratives to invest in Bitcoin, it's arguably one of the worst strategies you could do. I mean, look at this. This is Bitcoin going back to 2016. The first future contract was launched at the top in 2017. Very bullish narrative, and it marked the top. Elon Musk puts $1.5 billion worth of Bitcoin on Tesla's balance sheet right at the first top in 2021. We saw about a 40% drop from there. El Salvador, first country to adopt Bitcoin as legal tender, extremely bullish narrative, and that marked the top of the most recent secular bear market. What happened here? Oops. Sorry. So anyway, sorry, I went for it by accident. So narrative investing was a terrible plan historically, and even on the downside. The most recent was the FTX scandal. I mean, that was one extensive fraud after a string of bankruptcies in that bear market. But the narrative around that failure was that this was going to destroy the faith in Bitcoin, and it was never going to recover. And we're up, 700% since then? So narratives are not the best way to approach Bitcoin when it comes to investing. And history very clearly tells us that. So what moves price? Is it random? And it's certainly not random, not from our analysis. So 2 things that we look at. One is global liquidity. I'm not an expert in liquidity. There are people like Michael Howe, Darius Dale. These guys are geniuses when it comes to global liquidity, and they have very detailed models that will address this. But from our analysis, just to kind of give you an idea of how we apply this within the Bitcoin world, what I mean by liquidity is the availability of capital within the system, the global economic system, specifically how easily businesses and consumers and financial institutions can access credit. So how easily can you get a loan and roll over a loan? And you can't talk about loans today without talking about collateral, because 80% of all lending requires collateral. So how easily and cheaply can borrowers access collateral like treasuries, like real estate, All these things affect liquidity dynamics. And so the most important factor, or probably the most popular factor that controls liquidity dynamics is central bank policy, right? If they're raising rates or lowering rates, that's going to actually increase the ability to access credit, supposedly. But what I would argue is the most important, if not the most important, or one of the most important, is the U.S. dollar. 64% of all global debt is denominated in the U.S. dollar. And so what that means is if you're in a foreign country outside the U.S. and you wanted to participate in the 0% interest rates that happened for over a decade in the U.S. and get cheap dollars, and you took out a loan, and that's a fixed loan, you got to pay that loan in U.S. dollars. And so what that means is that the U.S. dollar is appreciating against your local currency. You've got to get more of your local currency in order just to manage that fixed yield on your debt. That means that's less money for you to put into risk assets like Bitcoin. On the flip side, if the US dollar is in a downtrend against your currency, then you have to really come up with less of your currency just to service your US debt. That gives you more money to put into Bitcoin and to risk assets. So the logic is there, but there's more than just the logic. If you look at the dollar index, which is basically DXY is the ticker, it's just a measurement of very popular U.S. dollar pairs. And so basically when the green line is going up, that means the U.S. dollar is appreciating. And what that's doing is sapping global liquidity from the system. When it's going down, then that means the U.S. dollar is depreciating against other currencies, which is putting more global liquidity into the system. And what you're looking at in the black line is Bitcoin. Now, while the correlation is not perfect, look at what happens when the U.S. dollar actually goes on a vertical move up and down. And what does Bitcoin do? You can see a very clear inverse correlation between the two. And it's been active ever since Bitcoin's been trading. Most recently, DXY topped in September of 2022, I believe, which was just 2 months before Bitcoin bottomed. DXY has been in a downtrend ever since, and Bitcoin has been in an uptrend, helping to prove that inverse correlation between global liquidity expanding and Bitcoin appreciating. So what DXY is doing is of utmost importance to me when it comes to Bitcoin. This is one of the ways that I'll generally manage the risk within Bitcoin. Furthermore, I look at sentiment patterns, which is basically all technical analysis is. It's just the measurement of what the herd is doing and about to do. And if you funnel, human consciousness into a quantifiable system like the stock market, strange patterns emerge. And they emerge time and time again on all time frames, on all markets, and going back throughout history. You can see these patterns like triangle patterns, bull flags, bear flags, head and shoulder patterns, cup and handle patterns, very common technical analysis patterns. They're just measuring what the herd is about to do. The most important pattern within technical analysis is the 5-wave pattern. It underpins all of this. It's really what marks a trend. And to give you an idea of what I mean by that, if you're new to this, is if you follow me here, what you're looking at is a crypto, an altcoin that was in a devastating bear market. So whenever it bottomed right here in 2023, the sentiment was just abysmal. And so we got this uptrend off the low with very tepid volume, right? There wasn't a lot of conviction in there. And the assumption was, oh, it's just another bear market rally. And then all of a sudden we got a drop. The belief was, oh, we're going to make new lows, but volume was light on that drop as well. And then what happened? Price went vertical, and this is the key. This is what, when it comes to these 5-wave patterns, if you can identify the third wave, then you're in business. The third wave, when it comes to sentiment, is when everybody gets on the exact same side of the trade. Shorts realize they got it wrong and they cover at the same time breakout buyers buy, and those that were early adopters, they want to buy more. So everyone's buying at the exact same time. Which causes price to go vertical. And it's usually met with the max volume within the trend and max momentum. The fourth wave is when gains are taken. And it's also where latecomers say, I want to get involved. I missed out, right? And so they start buying from those taking gains. And the fifth wave is a final move higher that happens on lower volume and lower momentum, less conviction because there's less involved. You can call it the suckers rally because what happens after the fifth wave is over is you get a three-wave retrace of the same magnitude. So this pattern is very important for this presentation, and I just wanted to explain it. Now we are going to get into the interactive portion of this webinar. So if you take a look at this is the S&P, this is the Bitcoin, a 3-day chart. It's the bull market that we're currently in. And take what I was telling you about three-wave patterns, these patterns, the third wave being the most important. Try to identify the vertical portion of this pattern. And it's right here from late 2023 to really up until late 2024. This is when price went vertical. It was also met with maximum momentum, and it was met a maximum volume right here and maximum momentum. So this was clearly wave three right here. Okay. We then have this congestion that ended in early April, and we're pushing higher to new highs on less volume and less momentum. And not only less momentum, but the RSI on the 3-day is below this 73 level, which is pretty key. Being on the other side of it, the north side of it is quite bullish, and tops tend to happen within this trend on the underside of it when it's used as resistance. So putting that into context, this is what I think is playing out. From the 2022 low, back and forth, vertical move higher. This is wave four that ended in April. And there's three ways that I see this fifth wave playing out. And I just want to be really clear that I think we're in the final fifth wave of the the cyclical bull market within Bitcoin. You can call this is basically the suckers rally. Now, this is a very large pattern that's playing out over many years, so it's a suckers rally worth playing, but it's worth knowing that this is wave five. And let's assume wave five ends where I think it might somewhere in the 128 to 149, or not think it might, but I think we're definitely going to make one more swing higher to like 133. But let's assume that that's the top. We're looking at a move down to 58 to 35,000 over the coming months. So not something that we want to hang on to, especially considering we've been buying so strategically along the way. So there's three ways I see it playing out. One is that we have all waves in place for this top right here at 120, what was it, 125-ish around there. That's all the waves you need. But I think we're going to get one more push at least to 126, 128, 133, maybe 149, somewhere in this red zone. And then we're going to see a pullback. So the bearish scenario would see us make that move and then start breaking through these key supports, 104.5, then 86,875 are going to be important. Below 86,875, and I think the top is in. And you can risk manage how you see fit with that. The other scenario is that we make a move higher, break 104,500, but hold 186,875. That would set us up for this final extended fifth wave to 200 to 224. Okay. And the most bullish scenario would be this kind of back and forth. We hold 104,500 and see a vertical breakout over 149. We would have to see volume expand, and we'd have to get back over this 73 level on the RSI. No matter what scenario plays out, we see this final fifth wave is not a place to buy and hold. That's not what we're trying to do here. That time we believe is come and gone. It's a time to trade the remainder of this move. Which some people don't like to hear, but we're not hodlers. We don't think that you don't have to hodl. I think that there's plenty of data to actually manage Bitcoin's risk. And just to kind of point out more risk that we see, the top chart is Coinbase. That's the blue lines right there. The bottom chart is Bitcoin. That's the black lines. And interestingly, Coinbase tracks Bitcoin quite closely, and they give off signals to one another. In 2022, you can see Coinbase making a final low into early 2023, while Bitcoin made a higher low. That's a divergence. And that's telling you that Bitcoin is not confirming the downtrend and that something's about to reverse, and it did. And you can see these divergences happen at key turning points where Bitcoin's making a higher low and Coinbase is making a lower low or vice versa. We just saw an epic divergence occur. Bitcoin, Coinbase went vertical. I think it's confirmed a pretty meaningful top. Maybe we get a jump back up to the to close this gap around 400, 405-ish. Maybe we make one slight high, but I think the risk is extremely high within Coinbase. While Bitcoin made a higher high, Coinbase made a much lower high. So that's not ideal. That increases the risk in our opinion. And then when it comes to the US dollar liquidity, like I was talking about, DXY, the downtrend started in the 2022 top in September, and we've been in a three-wave pattern, a downtrend ever since. The final leg of this downtrend is a C wave. It's a five-wave move where you will see, and you can see it very clearly playing out in real time. We have this back and forth, vertical move lower on max volume, max momentum. And now we're making one more move lower on lower momentum. I think we have one more drop down to like 95 range, but we don't have to make that. And once DXY goes over 101, I think we're starting a new uptrend in the US dollar compared to other currencies. That's going to sap global liquidity. And as we saw in the chart that I showed you, there is an inverse correlation between Bitcoin and the US dollar. That's not good. So once again, confirming that we're closer to the end than the beginning. Risk is much higher in Bitcoin, in our opinion, than I think most people are really taking on, and especially the bullish narratives are suggesting right now. So our game plan, as said before, is to trade this move, to raise our stops as we go higher, and to take gains at key spots, cut half, put it back in if we start getting evidence that we're going to get another breakout. Regarding the S&P 500, let's see here. We looking at a monthly chart on the S&P 500, and you can see from the 2000 top, we have a pretty clear, even though it was a multi-decade or decade plus long secular bear market, it's a very clear corrective pattern. We had a drop to 2003. That was your A wave. Your B wave made a double top in 2007, and then a back and forth vertical drop, 4, 5. C wave to the 2009 low. I know people find that shocking, but it's a very clear corrective pattern that had very huge macro narratives driving it. Since then, we've been in a very clear bull market. It's been a secular bull market. And if you follow me, just like with Bitcoin, we have a back and forth, back and forth, back and forth, vertical move higher as momentum starts to expand, all the way up to the 2018 top. That's your first big correction. I have that as wave 4 of this larger third wave. And then the most powerful move of a third wave tends to be its fifth wave. And so that's what we got up to the 2022 high. The 2022 bear market was a fourth wave, and we've been in this overlapping mess of a bull market ever since. It's been a bull market. It's been very rewarding, especially if you're in tech, but it's still an overlapping mess. And the pattern best resembles what's called an ending diagonal pattern. And so what we're going to do is analyze this final move in the bull market in 2022. And then we'll turn it over to Vincent. Like I said, it's an ending diagonal, the final move of a bull market. And there's really two ways that I see it playing out. Okay. So I think that the first wave ended in August of 2023. Second wave ended in October of 2023. The 2023 move all the way up to the February high that we just had was wave 3. Wave 4 was a very deep fourth wave, and we've been in the fifth wave ever since. We're either coming to the end of it. Maybe we get one more swing to 6,500. I don't know. That's not my primary scenario. It's just a backup. But until we break 6303 and 6210, I think we can keep drifting higher below these levels, and we are now entering the corrective phase of the volatility will pick up, and more so than I think people are really preparing for. My primary scenario is that the final fifth wave, this will be the end of the first leg. We'll get a corrective three-wave move back to 5920, could go as low as 5,500, and people think that's impossible. And then we'll get one more very large swing up into 2026, which will cap off the secular bull market. If we break below 53,445, then the odds are quite high that we have entered a secular bear market. So how we correct from here, I want it to be a three-wave pattern, and I want it to hold certain support levels. I do think until the market tells us otherwise, it's a buying opportunity. and we're gonna handle it that way. Now you may be thinking, oh well, this is the end of a secular bull market, so why would I even want to be investing? Shouldn't just sell everything and run for the hills. It's not the way this works. All it means is that investment strategies will probably likely have to change, and it's a very natural part of investing. Buy and hold was the name of the game for the last 15 plus years. You didn't have to be a genius to make a lot of money in this market. Buy tech and just hold it and buy every single dip. We've been trained to buy every dip because the market always corrects. But what happens when we enter the secular bear market? This was the last secular bear market that we had. 2020 top, it took 13 years, over 13 years for the S&P 500 to reclaim that 2000 bubble top. It's a long time to have money as a buy and hold, just waiting for it to come back. That doesn't mean that every single stock did that. Look at this. This is Apple. Went down 83% from the 2000 top all the way to 2003. I mean, that's a huge drop. That would require 400% just to break even. And in 4.5 years, it did break even. It reclaimed its bubble top and just never looked back. In fact, by the time the S&P reclaimed its bubble top in 2000, Apple was up over 1,000% from its 2000 top. Why is that? And the reason is because it was participating, it was the sole beneficiary of a very powerful micro trend. It participated in personal computing, and it participated and was the sole beneficiary of the mobile phone micro trend. And so that's what I want to point out. It's just because we may be entering a secular bear market, which is just what technical analysis is suggesting is a potential. It doesn't mean that there won't be winners and big winners that will kind of march to their own drum. And AI is definitely one of them. AI is projected to be 4 times larger than the mobile phone. These are companies that this is a trend that brought you Apple, Google, Meta, right? And we're already seeing a rotation of the FANGs into new FANG stocks like Nvidia, stocks like Broadcom, and it's only starting. So instead of being a buy and hold passive investor, we think active management, specifically tactical active management, is going to be the name of the game for the next decade. So anyway, I hope that was helpful. I apologize for the technical difficulties we had. I mean, what a time to have that. So anyway, apologies on that one. And I'm going to turn this over to Vincent. Just a quick introduction with Vincent. I met Vincent. When we had a forum on our service, he put up one of the most fascinating posts I've ever seen within our forum, which was he basically created what's now known as his phase angle. It was one of the most revolutionary, not revolutionary, but it was very innovative from what I was seeing. We were looking at ways to manage risks, to kind of have some kind of a hedging strategy within our portfolio. He posted that, and I contacted him and said, "Hey, would you mind building out a risk management signal that we could use within our portfolio?" And from that came Wealth Umbrella, which is some of the most innovative internal metrics of Bitcoin and the stock market that I've ever seen. So I'm going to turn it over to Vincent, and thank you everybody.
Yeah, hi everyone. Let me just share my presentation. Hold on. So do you all see my screen? So Knox, can you confirm that we see my screen? Yes. Oh, do you hear me? Is uh, could people confirm in the chat that you do hear me? Because yeah, okay. Thanks, Kevin, for confirming this. So just hold on. Again, technical issue. And okay, well, I assume you see my screen now. Uh, so, uh, as probably a lot of you don't know me, I would just start by, okay, just hold on, get news by Knox. Okay, so sorry for that. So yeah, I just want to introduce myself a bit for people that don't know me, since There's probably a new guest here. So I have a different background that usually you see in finance. So I am a university professor at ETS in Montreal since 2010. I'm also co-director of McGill Surgical Innovation Program since 2015. As a researcher, I'm a guy that do robot. I'm specialized into sensor technology, signal processing, and AI. Also, when I was a PhD student, I started a company that now is, along with Teradyne, we are the leader in the collaborative robot space, which led to us having total financial control over the stock market. Okay, no, maybe we just ring the bell. But we did our probably the only company that had Angela Merkel laugh through all his tenure. So that's my background. So I'm a scientist, I'm a university professor, and also I'm an investor since 2007, which was a very bad year to start investing. But I became more and more invest as I went through a secondary round with a lot of years ago. So anyway, so one of the things that really striking me when I started to be more invested is how internet, when I was looking to free information around, most of the information about investing was kind of noisy and a lot of them were shitty. There's a lot of things that I started to validate that I could read, and then I was coding an algorithm to validate that, and actually it proved me that most of those things were untrue. So I really found that the mismatch with institutional investor that had access to a lot of data was really a very bad mismatch. So along with some colleague and friend, we decided to start to dig into alternative data and data. Uh, and yeah, to start to develop some signal. As example, here is our margin signal that highlight the risk in the market to be on margin. And so we developed a proprietary quantitative signal, and we combine it with in-depth market analysis that we post. And we also have Data Hub to share all our data. So our signal, most of our signal is accessible to TradingView, but to have a more stable version and more signal and more access to a lot more data set, we also have our home data hub where we share with our member our signal. So anyway, I'm gonna now jump into the main topic here, which was Bitcoin and risk management. So just before I give my view on Bitcoin, which we see, I just want to be sure that everybody's on page with on-chain metric. So one of the very interesting thing about Bitcoin is the fact that the network is very transparent. You can actually observe all the transaction, what price Bitcoin was initially bought and what prices sell and track them. And just to give an example of the power of this, uh, in most of investing asset, we look at a market cap. In case of Bitcoin, Bitcoin market cap is the Bitcoin price multiplied by the number of Bitcoin in circulation. So that's good approximation of the value of the asset. But the thing is not a good representation of the actual money that flowed in because it's not everybody that bought the Bitcoin at current price. So the fact that we can look under the hood of Bitcoin make that we can actually look at each Bitcoin and what was the price last time they move and add all of this. And this is what we call the realized cap. And realized cap is the exact amount of money that have flow into Bitcoin. So when you can look under the hood, you can have interesting takes on Bitcoin ecosystem. And here, I want to give this example of it's not a metric we made, but actually is the metric that allow me to sold it up in 2021, but also to inspire me to make our work on Bitcoin. So here's the MVRV. MVRV is market value to realized value. So it's basically the relation between the market cap and the realized cap. So usually when Bitcoin start to be very overbought and very exuberant, the relations kind of spike. And yeah, so here's the previous relation. And then in 2021, I saw one analyst, and it's not necessarily I want to point the mistake. We all do some mistake, but the point is that person was saying we're not at the top as the MVRV typically climb above 4.2 during market peaks. And I remember at that time saying that actually each peak were decreasing, and which is makes king sense because it's understandable that as market cap explode and rise, it's normal that it take more money and to push it. So we expect that ratio to become smaller and smaller. And actually, this is what actually happened. So that analyst missed the top, and now we don't expect it to be at 4.2 in the next cyclical top, but probably more at 3.1 when it will reach that line. But I will come back to that a bit later in that presentation. But anyway, so what we decided to do is, what if we make unsigned metric that we will correct for the evolution of Bitcoin? For example, we take into account the supply of Bitcoin, we take into account market cap, realized cap, thermal cap, which is another way to compute Bitcoin value. So what if we would account for that? But also, what if we would make them unlinear in a way that they would spike so sharply around what we want them to spike that the exact level would not matter that much. So for example, here in that metric, although there's some spike that are up to minus 80, if you buy the bottom when the indicator goes to minus 40, you get about the same result. Because they are very highly nonlinear, they basically just rise sharply around that moment. And one other thing we also thought it was important is the redundancy. So when you look at Bitcoin ecosystem, it's a very complex one. It's not just about the investor. So there's investor like you and probably me, like me and probably you, but there's also economic network participant like miner. It's also about transaction fees, also exchange that are part of that network. And there's the network itself, is people that has mining rig, and you see that anytime that ecosystem, complex ecosystem is affected, it can trigger crash, but it can also trigger bull run. Like anytime that halving affect the economic network participant, it trigger a run. So you have the halving cycle, but also like in 2017, it was really a top driven by too many investors, like too many, no one to left to hold the bag. But also in 2021, we saw massive corrections during the summer due to China disconnecting miners. So every side of the market is important, and that's why we developed a top and bottom indicator that are trying to aim at those different part of the network. So one of the thing is actually those indicators that help us along with the IO found to identify the November 2022 bottom. When we saw actually all those indicators rise sharply around that time at the same time when actually FTX defaulted. So I wanted to take this example because that's around the time we started to work on Bitcoin with the IO Found, but also to help you understand a bit how our indicator work, because we have bottom indicator like this one, but we have also top indicator like the two that I'm presenting here. And we might wonder what those top indicator are saying now. So those top indicator are made with the same philosophy to spike sharply when we reach cyclical top. And those indicators have been very useful since this new cycle, as whenever we had a correction and we're seeing around on Twitter that it was the cyclical top. We're confident it was not, and we remained invested in Bitcoin because we knew that none of those indicators were close to a level consistent with a top. So now I wouldn't say that they're not close, partially considering that they're not non-linear. So they came a long way since 2022 bottom, but none of them have entered the top yet level. Our main Bitcoin strategy went when we first reached around 105K into blue color. So our strategy have different behavior that are associated with different phase. For example, in the red phase, we expect a bottom. So we're really looking at bottom metric and also our result, but we are quite defensive. When we enter the green phase, it's time that the risk is not being in Bitcoin, so we're less defensive and we'll probably ignore most of the correction. And when we enter automatically in the blue phase, like we did, it's where actually we think that the top is in, and it's time probably to be a bit more defensive. So those indicators suggest to us that it's probably not the top, but we already came a long way. I think we thought it could be interesting to see if we invert those model to see actually what could be the price of Bitcoin when they will spike and reach level consequent with a potential top. So it's not that straightforward because it's not just putting a value for that indicator and then looking at a price because there's other data. For example, like supply. So supply is relatively easy to estimate in time, what would be the value, for example, in a year or in 6 months from now. But there's other value like realized cap. We have to put hypothesis, but it's relatively easier to extrapolate those data than the price itself. So anyway, we managed to do it. But we'll first share the key conclusion. So I'm sorry. When we did that exercise, it appeared very clear that they don't suggest that $1 million during this cycle, like we see a lot on Twitter and in different other ads. We don't believe for this cycle, if this cycle ends early 2026 or at the end of 2025, we don't think it's possible. And not also the 500K we also see very often. Probably later, probably in the future, down the road, but not in that cycle. But yeah, other conclusion. So we first did that exercise almost 2 years ago, and our conclusion was 176K in a range of 144K and 200K. Because since we inverse three different model, they don't exactly converge to the same value, so that created a range. But also we have some hypotheses that give more bullish and bearish scenario. So that was almost 2 years ago. Naturally, we had to forecast other variable. So as we advance in time, we have more clarity. So we did the exercise again in July as we now think we are on the way to the top. And if we inverse two of our model, but also MVRV model, which was made by David Puel from, it's probably one of the best soldier of Cathy Wood in ARK. About Bitcoin. So if we inverse also his model, we all converge around 200K. The actual number, the average is 214 in a range of 203 to 229K. So, and before coming back to those value, just take a step back and I'm going to talk a bit about the Metcalfe Law Discount Premium model. So we call it the MLDPZ score. It's our model that spiked both at cyclical and non-cyclical top. So anytime we have kind of a hover bout wave. So like, for example, 2019, we had a good run. It did spike, although it was not a cyclical top, and it did spike also around the ETF frenzy and also in 2023. So it's not just a top indicator. So it's one of the model we use to know a bit where we are in each wave. And if we look at usually uptrend around that cycle lasts between 60 days to 80 days. So if we simulate the trajectory and we put it to the 3 to 3.5 standard deviation that it usually top, that indicator, that would bring us to 168K to 175K in the most bullish case. And so to us, it's illustrated that it's probably unlikely that we reach the top of this cycle in a single wave. And anyway, if we look at the history of Bitcoin, it's probably what we should expect because on the final push, there's usually strong correction that are pretty short live. So we simulated a scenario where we'd be 60-day uptrend and then 20-day pullback of 20% and then a 30-day uptrend. So this number were not random. We look at the history and thought it was kind of in line. That would actually, in those two waves, bring us to pretty close to the top end model we had at the top value here. So yeah. But so it's a model. Any model has uncertainty. So that is assuming that Bitcoin will continue to move it within its historical pattern. At that moment, nothing that really happened. And when we look at those indicators, tell us that it really break with the history, but it's always a possibility. Naturally, if Bitcoin would go to 500K, that would be a clear break with historical pattern. And we think that if there's a break, it's probably a more calm less euphoric Bitcoin rather than more euphoric because market cap now it's much more considerable. Uh, so these predictions rely also on assumption. So, like for example, what would be the realized price of Bitcoin in January 2026? For example, at that moment, it's about 53K. So it means that in average, the average Bitcoin has been about to 53K. So, but anyway, as time moves, we'll sharpen as Bitcoin evolve. But as you saw, the difference between our 2023 prediction and 2025 are not major. So we don't expect those numbers to change that much. But also there's uncertainty. So what if Bitcoin grind higher instead of exploding? So the simulation we did was for end of the year, early 2026 top, which is in line with this well-known 4-year cycle. But it could happen that a 4-year cycle is a story of the past. The thing is, the 4-year cycle was always driven by the halving. And we think that as the reward is slightly less now than it used to be, halving is not the dominant force anymore. And just to give that a very simple example, uh, if we look at the amount of Bitcoin that went back on the market, so if you look at the amount of Bitcoin that hasn't moved for a year in April, and if we look at that, the supply changed by 2.21%. So 2.21% of the Bitcoin that were idle went back to the market, and that inflow of Bitcoin available represent almost 1,000 days of mining in the current rate. If we look like 10 years ago or 8 years ago, that would have been a couple of days of mining. So maybe not couple, but let's say 100 days of mining. Didn't do the math, but so halving is not the dominant force anymore. I think right now the main force is ETF, and probably that will make Bitcoin more tight to a stock market fate. So there could be model uncertainty. So although we make that assumption that we should see it up to 14K, one of the things that I think is important to highlight is for people that re-entered around 18K or maybe that really scooped the 16K bottom, uh, the road toward 214K represent about a 12x return. And as price move, that return is exponentially decreasing. And on the opposite, where when we were at the bottom, the risk of this being the new top was pretty low. But that risk really linearly increased as time passed and as price of Bitcoin rise. So on one side, you have an exponentially decreasing reward, and on the other side, you have an increasing, linearly increasing risk. So I think this highlight the importance of managing risk at that point, and that kind of aligned very well with what Knox also was saying on the Elliott wave, but also on the fact that we had more done in that cycle that probably we have left. So, and I think it's important to highlight the fact that past cycle top were followed by 45 to 50% drop before meaningful bouncing. And I'm not talking about the whole drop of the bear market, just like the first drop, and then you bounce and then you drop again, and that's the bear market. But it's usually 45 to 50, and maybe with Bitcoin maturing now, correction could be more in the 35 to 45 instead of 45 to 50. But that means if we reach the target we thought around 214, that would bring Bitcoin down in the first down wave to 142 to 100 to about 120. So, and if the top come earlier than 214, the correction range would shift even lower. So that's told us that we will progressively lock in profit above that range. We are highly in profit on Bitcoin, and we think that the right things to do is when we will see our top indicator enter the euphoric zone, not necessarily at the top, but enter that zone. And most of our indicator, if you're a Wealth Umbrella user, it's a, it's when they start to rise in blue. We will start progressively to lock about 60% of our holding, and the remaining 40% will just do it on active hodling signal. And why not doing 100% of on the signal? We just want to be sure in case we can always be wrong. And although it is very defensive and it will not ride back down the whole bear market, we think, and there's a lot of protection into it, we still think that that's the appropriate way to manage, partially considering that is less and less and less profit on the table, and we already are highly in profit. So that brings to the conclusion. So in conclusion, we believe the top is still ahead. We haven't seen it. Our target is around 200K, and that's the convergence of a lot of model. And there's not a huge standard deviation on those models. They all converge around 200 to 230. So that's really where we think if Bitcoin is to go in line with its history and go over about as much as it used to be, uh, that's where we will probably end. And other conclusion is our MLDP's score told us that it's probably unlikely to get there in a single push, and that is quite in line with Bitcoin past behavior. And finally, as reward exponentially shrink and risk climb, it's soon time to manage risk and exit progressively, which is what we will do to be sure to not lose all the gain we made. So that was our view on Bitcoin right now. And maybe I didn't talk about price retracement, but at that moment, with about 112, 113, it's still a very, very moderate pullback. We wrote 2 weeks ago that we could see that pose going down to maybe 108. I'm not sure at that point if it will go there, but we're not worried at that point and think it's still a very moderate pullback. So thank you very much for your time. Apologize for also my little technical issue at the beginning. And yeah, Knox, we'll give you back.
All right. Yeah, we're hopefully you can hear me. We'll answer some questions here if you got any.
Yeah, we hear you.
Let's see here. Uh, So, question for Knox for investors that started recently, last 3 to 4 years, and still have a small portfolio. Is it recommended to try and fully exit the market in 2026 at all possible at a top, or do you think that tech stocks would still be worth holding? So, I am not a financial advisor and cannot give personalized advice to anyone and tell anyone what to do. I think timing markets, it's not as difficult as it's not impossible, but it is very challenging. And just let me actually uh, share my screen just real quick on this one issue. Let me see here where we at. All right, can everybody see that? Okay, cool. So talking about Apple, I mean, Apple started its hype cycle in 2009. The iPhone was released in 2008-ish, I believe. And let's see here. Look at that. So it's up 5,200% since it launched the iPhone. and it saw extreme volatility along the way. None of it lasted long, but it was 60%, 45, 34, 39, 41, 32% drops along the way. So our game plan is when it comes to stocks that are in defined micro trends, where our thesis is being confirmed quarter after quarter by earnings, is not to really sell those. We'll trim around the edges like we did with Nvidia. We sold half of our Nvidia really around January, February, I believe, of this year, and then we bought back around 86, 94-ish. So we'll trade around the edges with our core positions, but for stocks that are in these defined micro trends, I think buying Nvidia around that 86, 94 region, that's a good position to start layering a buy and hold. So we're really targeting some good buy and hold positions with key tech stocks, but the question is not like what you own, is how you buy it, right? Is how you own it. And so that's really what we try to do. Um, but yeah, anyway, our goal is to really identify levels that will tell you when risk is increasing, right? And so based off the patterns, this is the S&P 500 over a 1 hour chart. I think that we have a pattern telling us we might go to new highs by Labor Day, that we could see a move to 6,500 in the S&P 500. Granted, I don't think that the Qs would participate. I think they'd make lower highs. I think SMH, like semis, would make lower highs. You see divergences all over the place. And if that happens, that's your indication, and you see the divergences that you're setting up for some volatility. But your trap doors are 6350, 6303, and 6210 is the final below there, and you're in some volatility. You wouldn't really know based off the pattern how big the volatility was until you bottomed and got a large bounce, and we could start getting an idea of what that would be. So you just take it step by step. But the whole idea of just selling everything and buying it all back, I don't think that's I don't know. We don't do that. Okay.
Nux, if you allow me, I will take a
Yeah,
question.
sure.
I think it's interesting. I think you will have your take on that because we talked about that earlier. But one person asked if BTC price were to reach the 200K to 30 as a all-time high for this cycle, what we think would be around the low for the next bear market. Uh, I think the answer is interesting because I think Knox, you do have Elliott wave chart for that, and I had the data that converged to the same thing. So on my side, usually one of good estimation at the bottom is the realized price of Bitcoin. It's usually um, realized price at the bottom. Bitcoin usually dip about just a tiny bit under the realized price. So, like I said, the realized price is the actual value of the money that's been put into Bitcoin. And at this moment, the value is at 53. But if we look from that point and with our indicator, we can expect to see realized price appreciate by about 20-25% until the end of this cycle. So that would probably be into 70, probably around the 70 and usually to trace a bit. So that would probably around 60 K. That would be just very easy prediction, that tight. And maybe Knox, you want to show your chart on that?
Yeah, happy to. Just let me see here. So I don't want to go to that one. Let's go to the weekly. Let's assume that, or we'll just go to the 3-day chart. Let's assume that this 5 wave move makes it to 200. Let's say like that the bull count plays out. I would argue that this would be a very, very large first wave. Um, and we'd see a very, very large second wave. Um, and so let me just kind of make it all nice and neat right there. And historically, or just using probabilities, like the vast majority, let's assume we get to like 200, the vast majority of second waves will retrace back to the 38 to 61% retrace. These are very general projections. Once you start getting these railroad track bars down, you can get very exact projections of where it might go. But generally speaking, you would see a move over many months. It'd have to be of the same degree of this multi-year bull cycle back to 75 to 40. Now, in rare occurrences, it could be as shallow as 109, and even rarer occurrences, it could be as low as 28,000. But if you go below the 78.6 retrace level for a second wave, then the odds are that you're not in a second wave and something much nastier is playing out. So that would be our target. I mean, I see the 70,000 range is where we'd probably start layering back in. 40,000, I see a lot going on there. If we get down to 40,000, I mean, that's be backing the truck up around there. But sentiment would be so abysmal around there that the thought of buying Bitcoin would seem insane. So that's just how sentiment works from our experience. So yeah, we'll have to see what plays out. Okay. See more questions. How do you decide a position is risky? How do you decide at what levels to stop out and when to remove stops? Fundamental analysis has a lot to do with that. If we see a thesis and we start seeing deceleration with key metrics, for example, if we start seeing, we were invested in Tesla and it was all about margins when they started lowering their car prices. And it was a very specific kind of margin that they were showing in the report. And then all of a sudden they stopped showing it. And you had to figure it out yourself. And instead of showing this margin metric that was very important, they started talking about robo-taxis. And at that point, we were like, oh, no, risk is way too high here. Their margins are decelerating greatly. They're hiding key metrics and they're talking about pie in the sky technologies that may manifest and will manifest one day, but not today, right? They're not driving revenue today. So fundamentals have a big part of that. Technicals have a big part of that too. When technicals and fundamentals line up on the risk side, we get out, and when they line up on the bull side, then we make it a really large position in our portfolio. And Vincent, feel free to jump in if you see one you want to answer. Just
Yeah. One question people ask is the model and the prediction we did for the around 200K. Um, if it was for the end of the year, so yeah, maybe I went quite quickly for that. So since it's path dependent, we had to look at what at a certain date. So we try to align with this 4-year cycle, and we're usually Bitcoin peak, which is around the new year. So that was different scenario for around Christmas 2025 to March 2026. So why this is also why we mentioned it as an uncertainty that Bitcoin could break with its story and this 4-year cycle as halving is not a main force anymore. So it could grind for longer and maybe be less euphoric, but last longer. Or anyway, we'll see on that. But yeah, the prediction we did was what would happen if we would have a top around that time of the year. Also get a lot of question about ETH, Ethereum, like do we have prediction for Ethereum and timing, and do we have metric for that? And the thing is, when we develop our on-chain metric, we kind of use the same on ETH. One of the problem is ETH don't have the same history, so we couldn't look back as far, so it was harder to trust the data. So it's one of the reasons we didn't put them available. And one of the issue is, as probably a lot of people know, is in 2023, if I remember, they completely changed how the network work with proof of work. And the point is, we think that there's too many things that changed inside of the hood of E to be able to trust the past history before that change. So that's the long answer. So in short, no, we don't have model for ETH at that moment.
I'll throw in a freebie on ETH. We recently closed our position on Ethereum for about 150% gain, and I spent a lot of time reevaluating on where I could be wrong. And oh, wait a minute, is this the one? Um, no, this is this here. Let me pull it up right here. Let me do this. Ethereum, where are the updates? Oh, it looks like my system. Okay, so I'm just gonna have to walk you through this. This is the very generally what I think could be playing out with Ethereum is that um, either we put in a pretty big top right here. We wouldn't know really until you get down below 1985. That's too low to really manage risk around. The other scenario is this. I think this has a pretty high probability, something along these lines. I think there's a lot going on in the 9,000 to 10,000 range. So if we ever got there, that would be a big deal. Right here, we could see probably a drop below 3356. I do know that number. I remember that. If we can hold above there, I think we're going to see a drop down to 37 to 35-ish. And we probably start buying back in around there with the stop below 3356, below 3356. And we're going to be in the bigger correction, the one that's issued in red. And we could see a drop back to 3,000 to even 2,200. If it's a three-wave drop like that, that's pretty bullish. And that'd be a buying and setting up for a big move higher. If we can hold 3356 in the coming correction, then we could be seeing something a lot more bullish in play, which would be, it would look like this right here. One, two, we see probably a three, four, and then we get like our fifth wave up to like 9,000 range, a more direct kind of push higher. It'd just be a buy the dip till you get to your target. So that's our game plan with Ethereum. We took gains. We're looking to get back in on this coming drop that I think is going to intensify, but 3356 is like the line in the sand. Like if it can hold that, then immediately bullish below there, risk increases, but the pattern will be what tells you if you want to buy it or not. Okay.
I have a question here about a couple of questions actually come back to the $1 million Bitcoin and if I think it's possible down the road. So I think I made it clear in my presentation that if the end of the cycle happen in 2025 to early 2026, I really think it's impossible. Or that would mean that Bitcoin completely break with its story, which would be very surprising as it is actually harder to push now as the market cap increase. So I know that probably one of the most well-known estimated of 1 million and more credible is probably Cathie Wood team that say that it could go to 1 million by 2030, if I'm right, if I remember right. And actually tried to work on that assumption. Naturally, it's 5 years down the road, so it requires a lot of speculation. I don't think it is impossible. Those predictions made by them is driven by an analysis of inflow of money, like if all pension fund put some money, if all bank put that amount of money, and that it could push, and also relation to the market cap of gold. And so point is, yeah, it could. Honestly, some of the simulation we did, although there's 5 years down the road, a lot of uncertainty, I would say that I would believe more to the 500K to maybe 700K for in 5 years from now if Bitcoin continues to be bullish. And also it starts to become very hard also to believe in terms of market cap. So if Bitcoin reach $1 million, it means that market cap would be like around 9 times bigger than now, and that would be very, very huge. Partially now it would start to be considerable in comparison to the total stock market. Not as big, but not as negligible as now. So $1 million Bitcoin is maybe not for now.
And just to piggyback on that, what's the research, the analysis, the reason why it will go there? And if it's some narrative-based claim, you saw the pitfalls of investing in Bitcoin because of that. We tend to see these wild speculative targets when you get closer to tops than not. That's just the way sentiment works. But yeah, I do think probably in time it will reach there. But I mean, what does it mean if they say Bitcoin's going to be at $1 million in 10 years, but you're probably going to have to go through like an 80% or 60 or a couple 60% with or drawdowns in that time frame is kind of meaningless, you know. So both Wealth Umbrella and I, we've had phenomenal track records with crypto. We were selling the 2021 top, and people were not happy with that, and then we were buying the 2022 lows, and people were not happy with that, and we've been buyers along the way. For us, up until now, where we're now kind of sounding the alarm that risk is increasing, though we are still cautiously bullish. So, anyway,
But
go
that
ahead.
is true, by the way. Next, every time we bought into a difficult time or old through always get some eat. And I think it's a good indication when usually you're right is but yeah, buying in 2022 was tough, but also holding in some other moment was not that easy because you see a lot of people calling the top or that Bitcoin goes a lot lower. But yeah, so far it turned out to be a relatively good track record on Bitcoin.
Yeah. Someone's asking me if I would chart gold, and for feeling so bad about having those technical issues, I'm happy to throw a freebie out because I do chart gold. I think it's an important chart to track. This is what I see playing out. I think that we are in a fourth wave. I think we're going to drop back down into 27, maybe 25. Three-wave drop. Probably going to see another run higher. Up 30, 35, 9, 4,000, somewhere around there. And that's going to set up a relatively large top, in my opinion. So that's what I see there. Has absolutely, very indirectly, has very little to do with tech, but there you go.
One other question I get, and I think it's an important topic, is one person has that typically Bitcoin winter cycle beginning by October end. So how will it reach top by December? So okay, first of all, for example, 2017 top was around New Year's Eve. So it's not necessarily October hand. That's what happened in the last cycle. But anyway, it's true that in the past it was mostly around the end of the fall, beginning of the winter. That being said, think it's narrative we see a lot that people look at. Yeah, it's been 400 days since that event in the past cycle, and I really think it was not necessarily a coincidence in the past, as really was halving that was at almost 4 year interval that was clocking those cycles. So I think it's one of the reasons why those cycle in time, and it was easy to make this analysis, but it's not 100 of cycle before. So it's not a law that are on like 20, 25, 30 point data point is basically treat up before the other one, the last one. So point is, I think right now as the halving is not that much for a driving force. And for example, what I said is probably ETF buyer is the most impactful on the supply crunch right now. I think we should expect to go outside of those exact time. And I think we should not look at what Bitcoin is in time and say, hey, it's October, it's probably going to top, but rather looking at the on-chain metric and say, hey, it's super overbought from that metric and that metric, and it's probably at the top. And I think maybe it's something we should see at this cycle or maybe at the next cycle that will start to look at Bitcoin in terms of amount of days since that event in a previous cycle. So anyway, the main point is be careful with looking at Bitcoin in terms of time rather than where it is actually in terms of price.
We're being asked, what is the risk in quantum computing and how will quantum computing potentially affect risk within Bitcoin? From a micro trend perspective of investing in tech, while quantum computing is a very innovative technology, as is Web3, as is 3D printing. They're simply not scalable right now. And you can see that quite clearly when you start thumbing through these fundamental reports. And so until they become scalable, we have no interest in investing in them. It'd be just pure speculation. Now, Vincent, you might know more about this than me from what I understand with the mathematics around Bitcoin and the security around it, that even quantum computing would be unable to really hack Bitcoin. I mean, it's one of the most secure protocols out there. So not really concerned about that right now. Um, that's just me.
Yeah, no, we are very far. In theory, the SHA 256 is something that quantum computing could break, but actually the computing power of the network is so high that it's pretty almost unhackable. But the point is, we're very far from the point we'll be able to. So theoretical proof have been done. but we're very far from that point. So I wouldn't be concerned for the upcoming future, like a decade or two, and maybe in the future it's possible, but not now and not in the next decade. And I know actually over my office at the university is the biggest quantum computer in the East Canada. So one question I find interesting here is ask if me and Knox hold Bitcoin personally. And on my side, I think it's important to answer to that is yeah, because I really believe in Bitcoin. It's not just to make a service. Actually, we developed the tool for my own investing at the beginning, and the fund that we put in Wealth Umbrella came out of my pocket. So yeah, I do own Bitcoin, and personally, if you remember, if you were an investor at the end of 2022, I had a hard time. um During 2022 to find a place with as much upside that was clear than in Bitcoin. So I had a lot. What I said that with Wealth Umbrella, I will start to manage risk and exit. I will also do it to personally. If you have been with Wealth Umbrella, you probably have heard about my infamous zero that I had to buy the dip in my personal account, and then it went on margin. So I had an extra zero and went full on margin and was miserable for 4 months in summer 2024. So naturally on that, it turned out great and it was just too much on margin. So I sold it. But point is, I still hold Bitcoin and actually follow Wealth Umbrella indicator for the exit, and it will follow personally exactly the same game plan that I will do with Wealth Umbrella.
Yeah, I'd reiterate, I don't hodl. I've been through a couple of these Bitcoin cycles, and I don't have the emotional temperament to hold to hold a position for an 80% drawdown. So that's why we do this is I think there will be a point in time, probably the next year or so, where we probably will hold no altcoins and Bitcoin will be 1 or 2% of our portfolio. We did that back in 2021. We had an altcoin that was in our top five and we dropped it down to 1%. That was before like a 90% drawdown. And Bitcoin, we did the same. We cut it in half around 20 in 2021 and started, tried to kind of find our entries in 2022 and stopped out and started really buying in like early 2023 and just kept accumulating ever since. So that's how we're going to do it. I do that in my personal as well. I'm not a hodler.
Maybe on my side, one last question I will take, and maybe Knox, you have something to say about that. But we got several questions about MicroStrategy. So what do we think of MicroStrategy? On my side, and that's just me as an investor, whenever I don't totally understand the model, like in case of MicroStrategy, a tech company that do computing stuff that have more Bitcoin and make more money and leverage on Bitcoin, that is every time I have a hard time to understand, and I'm not saying it's not a good investment, it's just on my side, I'm not sure of understanding the company despite the fact that I read a lot. So on my side, I prefer to have opening a position into a stock miner uh, that were holding Bitcoin to me with making much more sense than one of the leader in the market of Bitcoin mining that was actually holding his Bitcoin through the cycle. To me, it was business I could understand. I could understand their leads. So on my side, I invested in that for that play that usually have leverage in Bitcoin. The leverage didn't play so far this cycle, but I still think it will probably in the euphoric phase of Bitcoin. But so no, I have no personal projection for MSTR. Do you have Nux?
No, we don't. I really don't track MSTR at all. We track a lot of the miners because of their potential for affecting the AI energy moves, but that we don't track it too much. One question, which I think is important, I'll answer this. If Bitcoin's price were to reach 200 to 230 range at all-time highs in the next bear market, what would the lowest price range be, given the new administration, institutional interests, etc.? And that was the whole point of what I was trying to show is like these narratives, though bullish, tend to be the most bullish around major tops. So if there's anything you could take away from this is, what from my experience, narrative-based investing in Bitcoin is arguably the worst way to do this through history. And there is a method to the madness of Bitcoin's price movements, which we've been showing you in real time. So this is stuff that we go over every week. I know we had a technical difficulty here, but I think I've only had two in the last like 5 years. So, but we go through these charts interactively every single week. I answer questions. I mean, I'll stay on webinars for an hour and a half just answering questions to our members to make sure that they are comfortable with what's going on, what we see, and we're not always right, but we're very transparent with what we see and how we manage risk, and we've done pretty well so far.
And I think what you're saying is also true for the stock market. I mean, I think we all saw since for the last 3 years how many economists got it wrong. So I think it's probably chart and managing risk and technical indicator or data is probably more significant than those narratives.
Yeah, our and our advanced tiers where we do these webinars. And yes, once again, but even if so much institutional interest internationally these days, do you think Bitcoin price will fall that much in a bear market? Once again, the narratives. I just, I don't think the narratives really help. I think that these are very bullish developments, but I think that there are forces driving crypto that are relatively new and have a lot to do with things that are not talked about in the media. Who wants to get on media and start talking about five-wave patterns and expanding volume? And no one wants to hear that. They want to hear the narratives. And narrative-based investing is just not a good way to do this. So yeah, bullish, but does that mean it's bullish right now? And that's, I think, a big differential.
Yep. And if you look at the metric, like I show, for example, the MVRV, it showed that the top is not as bullish as it used to be. I mean, it's decreasing amplitude, and it's also true for the bottom. So definitely, we'll probably not see a bear market of the amplitude of what we saw in 2017. But is a 50% retracement would be possible? Is a 60% retracement? I think it is. If you look at all the good stock, what they did in 2022, even though they had very high market caps, similar, just think of Tesla, it's a retracement of 50. So if a stock that has a lot of institutional investor were able to retrace 50%, 60%, Bitcoin could still retrace that amount, but definitely not in the range of 2013 or 2017, or actually the bear market that followed that peak. But definitely, yeah, I don't think that Bitcoin will always be bullish and just see a small bear market for the rest of his life.
I'll answer this. So if tech is generally in a secular bear market for several years, would your fund stay open, but perhaps in non-tech assets, awaiting the next tech spring? Tech moves in cycles. We saw that in 2022, but it's kind of it's the focusing on the secular trend and not the cyclical trend. So what really ended in 2022 was the seventh to eighth inning of the cloud computing micro trend. And I know a lot of investors still are believing it's going to come back like it did. It treated them so well for so long, it's going to come back. And it's just the hype cycle's done. The AI cycle, on the other hand, which is looking to disrupt segments of cloud, is just starting. And this is a decade-long hype cycle. And so please understand that even if the market may just keep going up another 5, 10 years, and that's what I'm saying is whether it does that or goes down, we have a game plan for both. We are invested, even though we're cautious, we're very invested right now. And until major supports start breaking, we're really not going to start acting on a defensive basis. However, assuming the worst case scenario and we enter a decade-long secular bear market where the market goes sideways to down for 10 years like it did in 2000, 2009, hopefully that Apple chart showed you that not all stocks will participate. And the reason Apple did not is because it was the Nvidia of the mobile hype cycle, micro trend that started in 2009. It was up 1,000% by the time the S&P 500 reclaimed its 2000 top, 1,000% higher than its 2000 top. So my point being is we think tech is only going to remain the most valuable sector within the broad market, and that's only going to continue, especially with AI. And instead of being an easy buy and hold passive investing winner takes all kind of strategy, I think you're going to enter a scenario where passive will get hit quite hard. Not having a risk management plan will get hit quite hard. And a more active and tactical portfolio manager or strategy will do quite well, even with the market going down. So that's our game plan, and that's what we think will happen. And we manage risk quite creatively. We raise cash. We don't diversify, which I know people think is the opposite of managing risk. But what's the point of holding a stock for diversification reasons if it's not really participating in any of these cycles? And we hedge our portfolio. So that's how we do it.
Yeah.
Okay.
If I can share one thing on that, so as I said in when I introduced myself, I hold a company in robotic that are relatively big, and we have a firm advisor in New York, and they were telling me that VC funding, only 20% of VC funding still invests in companies that make real product, physical product, and 80% of them is just tech. And the point is, there's a reason, structural reason for that. It's not because it's a trend. There's naturally trend into tech, and we have seen it. But tech is will probably always continue to outperform because these are the reason why VC are attracted is because tech company can grow at a pace that a company that produce tangible product like physical product can't. And also, tech company as profit margin can attain profit margin is impossible when you have production line and stuff like that. So I really think that even if we have a long bear market in the stock market, if that would be happen, tech stock like the one covered in the IO fund will still probably be the pocket of stock that will outperform. Not every tech stock, but definitely it will still be tech, and that's probably the main reason. It's not a trend of tech, is the reason why tech has been the leading sector for the last 2 decades.
Excellent. Well, we'll go ahead and wrap it up right there. Thank you everybody for attending, and once again, apologies for the technical issues that I had on my end. I'm glad we were able to work it all out, but yeah, hopefully this was helpful. You can probably see a little bit into behind the veil of our returns, and there's more to the madness than just writing reports and telling everybody this is a great stock we bought it a long time ago. We really want to show people, it doesn't really matter to say, oh, hey, we bought Nvidia in 2018. Good luck. People want to know, do you own it now? If so, at what percentage? Did you sell it? Are you going to sell it? If so, where? And that's what we try to cover within these presentations and within our webinars that we do on a weekly basis, both here and also at Wealth Umbrella regarding a more quantitative approach with the broad market and Bitcoin. So anyway, we'll probably have more of these in the future. And thank you so much. Hope everyone here has a good evening.
Thank you, everyone.